So let's go into liquidity mining because that's going to be a bit more on the complicated side. Let me just see if I missed anything. Yeah, might be a good idea to have this a bit clearer hidden, Ben. I agree. Great. So let's talk about liquidity mining. And now it gets a bit more complicated. It also gets very, very attractive because suddenly now you can actually make 60% on your Bitcoin versus 6% in lending. But just keep in mind, now we're talking about a high volatility product. And the reason why it's high volatility is because if you put a Bitcoin in, it doesn't necessarily mean that you're going to get a Bitcoin out. Even though you get 65% annual return here, the reason here it's return is because you cannot automatically reinvest. And you'll understand that also in a second. So that's why there's APR and not APY here. So let's quickly run this through here in this rundown. And let's talk about this third one here. So number 3, it's liquidity mining. And we started that in, I think, Q4 2020, maybe at the end of Q3, but definitely Q4. I'm not 100% sure. And that definitely also had a big impact in all of it. If I look at what I call the 7 functions of DeFi, decentralized finance, the very first function that a financial system does is it creates value. It creates money. It just creates value. And in my opinion, Bitcoin is very dominant in that, right? So it's very difficult here to compete with Bitcoin. So again, I would probably not want to invest in coins that try to compete with Bitcoin, but that's just a personal opinion. Obviously, many other coins try to do the same, but I think that is really the winner here. The second one is the transfer of value. And at the end, you will see it's always about value. We could say that Bitcoin is that. I'm struggling a bit with that. If it is actually Bitcoin that that does that, but you could say that at the end, it doesn't really matter. Here, it's basically not investing into the coin. Here, you're investing into the consensus algorithm because you suddenly take part in that, right? So it's either you invest into mining or you invest into staking. And so at the end, that is a function that you can do at Cake. You can actually buy Bitcoin, but you cannot do that with Cake. We use a third-party service. I can show that to you because I have a Singapore registered account and we exclude that in Singapore, but it's very self-explanatory. So we allow you with external partners to actually buy coins. So we tick that box. So on Cake, we allow you to participate in that first function of DeFi, which is basically just buying crypto. The second one is we allow you to participate in the transferring of value via participating in staking. So quite straightforward. The next function that's very relevant when it comes to DeFi is obviously lending value. We allow you to do that as well via lending. And so you can see already the order here, right? So let's go to function number 4, and that is exchanging value. Now, exchanging value is also something we have. Instead of centralized exchanges like Binance exchanging value, it's actually the blockchain that does that. And again, always here, the key thing is Cake is just always providing a technical feature. Cake doesn't create that service. It just provides access. And I know that sometimes it only provides access to one blockchain, but over the next 2-3 years, you will see that we will actually be very blockchain agnostic. We want to add several blockchains on Cake. It's not only DeFi chain or it's not only Ethereum. We want to add the Binance system. We want to add the Cardano system. We want to add Polkadot, and we want to add Cosmos, and blah, 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 blah. So we want to offer all those 7, probably 6 at the beginning, because the 7th is very questionable if it will ever be created. You will see in a second. But we really want to offer that to our customers, blockchain agnostic. That's very important. Exchanging value is also different from transferring value. Transfer is just a one way, so it's A to B. But in exchange, it's A to B and B to A, right? So that's relevant, and I'll explain that to you in a second. But just to kind of have a bit of a preview, there is the concept of tokenizing value. And we're not talking about centralized tokenization, what stablecoins are doing. So you lock up $1 and you create a dollar stablecoin. We'll talk about decentrally tokenizing value. And that's something the team is actually working on right now. So I'll make a wave here because depending on when you watch this video, hopefully we have this tokenization of value live. This will allow Cake to have stocks, and commodities like oil and blah, 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 and gold and so on. So this is going to be absolute breakthrough. And the key thing here is this is not storing a Tesla stock and then creating a Tesla token, because that actually makes you a security platform. So this makes you highly regulated. But here it's about the blockchain doing this, which is completely different. And I'll explain that to you in a second. Then it's about predicting value. So obviously a lot of futures markets, option markets. These are also things we would love to have, not this year, but probably next year. So this is coming in 2022. So this should be here end Q3, beginning Q4 2021. That's predicting value. And that's obviously really, really crazy. Then futures platforms, options, all decentralized on the blockchain. Very, very nuts. The last is identifying value, or it could also be reputation of value. And here we actually get into the entire concept of decentralized identity. Very big question mark here if this will ever get created. But if you look at the actual entire financial system, right? So you look at banks, this is what actually banks do as a whole, nothing else, right? Banks make money on those 7 things. Banks make money, banks charge you, and they charge you for creating that money. There's always an interest. They charge you for transferring money. They charge you for borrowing money. They charge you for exchanging currencies. They obviously make money as the broker when you want to invest in stocks. They make money as being the prediction centralized party. And obviously they make money because they identify reputation, they identify you, they can give you a good standing, a bad standing, and in all of that, they always make money, right? And so if you actually think about it, DeFi, and many people forget that Bitcoin is also DeFi, just very basic DeFi. It's definitely number one function, maybe number 2, but it cannot do any of the others. Ethereum then came in to really kind of say, you know what, we want to do everything. Not only DeFi, but also NFTs and so many things. And it's very questionable if Ethereum is really perfect for DeFi. It's definitely a great blockchain, but it's just so general purpose that many times people forget, is it really smart to have something so general purpose? But if you think about it, actually, it's those 7 functions that make up the banking system. And so blockchain just came in and said, you know what? Let's disrupt all those functions. Again, very questionable if they can actually do the 7th, but it doesn't really matter, at least the first 6. Let's disrupt all that. And Cake is not creating services in there, but basically being an aggregator, a marketplace to put all those functions on the platform, provide people with cash flow, provide them with making money, and then Cake takes a cut from that. Yeah, and so what I want to explain to you now is a bit of this one here, number 4, and kind of preview number 5, and just give you a very tiny glimpse of number 6, just so you have a bit of an idea. And then in case we would ever have those first 6 perfect, you could, in theory, somehow provide people with an identity via the blockchain. So suddenly people may have a chance in the future to say, you know what, I don't need my passport. What I really need, I'm just going to give you my profile of my DeFi status on the blockchain. And based on that, that is my financial standing. That is my reputation. That is the skin in the game that I would do, right? And so that's just very theoretical. Again, a lot of question marks here. This would be very futuristic as a whole. Let me just open the chat because maybe on this one, there's now a lot of questions. Rectify. Yeah. Heckfi. That's also funny. Okay, so let's talk about this exchanging value. So that is now here liquidity mining, and let's explain this first. Normally, you have a centralized exchange, for example, Binance, and you have user A here and user B here, and there's an order book, and one person makes an offer, and the other person accepts based on that order book. So someone makes a bid, or the other one makes an ask. The one person says, I want to buy. The other one makes a sell. It's always based on the order book, and you can take that or you can offer. Very traditional. At the end, the CEX always makes a cut. The thing is here is it's relatively efficient. It's definitely fast. It's relatively cheap actually, even though there is a cut, but it's relatively cheap because these centralized exchanges actually go down with the prices sometimes relatively far, so it can be actually super cheap. And sometimes these centralized exchanges don't charge anything for a certain period of time, or they allow you to use their company token to get a better rate. But there's obviously one key thing, and that's actually why a decentralized system, that's the only advantage, let's be honest. That's the only advantage a decentralized system always has, and that is that of trust. So decentralized systems are slow, they're inefficient, and most of the time they're actually more expensive than companies. I know many times it doesn't look that way, but a decentralized system's like advantage is not being cheap. It's actually always more expensive. It's just that decentralized systems can charge so much that these decentralized systems always look so cheap. But in theory, there will always be a small fee for a decentralized system, has to, because there needs to be a cost. And this cost can be hidden. It can be a transaction fee. It can be inflation. There's always a cost in a decentralized system. Otherwise, that system is not going to work because you would have a cyber attack, right? There needs to be a cost. In a centralized system, they can make something free because they charge something somewhere else. Again, there's also a cost, but the cost is very different. Best example, Robinhood, for example, right? So Robinhood goes and says, oh yeah, you can trade for free. You can do it super efficient. You can do it cheap. You can do it fast, because we're selling your data to other large market makers who then trade against you. But in theory, you trade for free on our platform. So again, centralized systems will always win on those three. Decentralized systems will always lose on those three, but there's this major intermediary, and that's trust. And that is huge. Some systems, right, especially decentralized, obviously they also go because they are open, which means they allow for things that centralized systems don't allow for. Now here, there's always obviously the question, is this like compliance wise helpful or not helpful? Is this rather spur criminal activity, or is this gonna help? For example, whenever we had decentralized social media, people always thought, oh, this is fantastic, no one can censor it. Yeah, but at the end, a lot of child pornography was on there, and a lot of activity that was hate speech and that was racial. So many times that thing is a bit of a question mark if open is actually really the good thing. Again, I'm someone who likes to have little regulation and who likes to have open markets, but it's not actually proven that this is going to provide a better user experience as a whole. Probably at the end, some kind of mix is helpful, because I think we all can agree that no platform, or there's absolute zero value in child pornography. Actually, it's absolutely disgusting and hurtful and illegal, but that is not even the moral side of that story, right? So there's very little and kind of advantage here. And in crypto, many times this happens very similar. Many times activities that would not be allowed in centralized systems then get started in open systems, in decentralized systems, and people see this as an advantage. In some small parts, it actually is, but many times actually illegal activity happens here. So that's why I always make a bit of a question mark. And illegal to me is not always from a legal standpoint, so it's also from a moral, from a very questionable kind of moral standpoint. Many illegal Ponzi schemes, for example, work on open systems, simply because they cannot be shut down. But the main advantage for me for a decentralized system is this trust factor. So you don't have this centralized party. The very famous one with Mt. Gox that actually caused the 2013 crash came from there. And obviously, whenever there's a centralized system, there's always this trust aspect, right? So that's key. So how would this then work in a decentralized system? In a decentralized system, the big problem is as soon as you try to create an order book, it actually is centralized because someone needs to control that and run that order book. And having that on the blockchain, it could in theory work, but it would be extremely inefficient, extremely expensive, extremely slow. So people wouldn't really kind of run this route. And so it actually, the DEXs started relatively early. It was just never really efficient. And then Uniswap was actually the first one to come up with this idea, and everyone thought this was crazy, and then it was absolutely genius. And the idea behind it is that you have people who create a so-called liquidity pool. And a liquidity pool is always a pair. So you have a left side and a right side. And for example, on the left side, you put in Bitcoin, and on the right side, you put in DFI. And whenever someone puts funds in, you start with a certain percentage, right? And it actually doesn't matter with what percentage you start, but let's just say you start off with the percentage for, you put one DFI in, one Bitcoin in, and 10,000 DFI, and you always have to work in pairs. Whenever someone wants to add liquidity, so you add liquidity, you have to use the same pair percentage, the same ratio. So you could do 0.1 and 1000 DFI, but you could not do, you can, but then the system automatically adjusts it and you lose. So people don't do it, and we actually automated that you cannot use a false ratio, because it would actually, you would actually burn the higher side. So it would actually be absolutely destructive. So you would always use the same kind of ratio. And now the interesting thing is the following. The price of the DEX is not an order book like in a centralized exchange. It's actually the ratio that's in there. So in this case here, the price of Bitcoin, 1 BTC equals 10,000 DFI. Or to say it in a different way, 1 DFI equals 1 over 10,000 BTC. And so now comes the interesting part. If you think that, for example, DFI is extremely cheap here, you could go and you could buy DFI. Now, how do you buy DFI? Well, by actually using the DEX, not by adding liquidity, but by actually using the swap function. And instead of adding on both sides, you just add either on the left or on the right, and you get the other side. So if you think, wow, 1 DFI here is super cheap, then you would add on the left side at 10,000 of Bitcoin, and you would get 1 DFI out. And then if you, again, so now what would happen is, here on the right side, you would be missing 1 DFI. And now on the right side, there would be a tiny little amount of Satoshis more in there. So you may still say, oh wow, DFI is still cheap. Okay, so you add another DFI. Oh, it's still, you add a little bit here on the left side. Oh, you get another DFI out. That was relatively cheap. And you could do this until at some point, and we call this, the pools are balanced again. And so what are they balanced against? Because they're always balanced. Well, they're balanced against other platforms. For example, Texas, or actually other DEXs. And so they become balanced. And so what you actually have, you have a lot of arbitrage traders who actually balance those pools. If you just had a single pool, a pool would always be balanced because you just had a single pool. But because you have other centralized exchanges and other DEXs, these DEXs can be unbalanced. And then you have arbitrage traders that come in and pick one side. Now, a pool actually is always slightly imbalanced, but many times it's so tiny that you can't really benefit from it. And so now the question obviously is, what are the economics in this entire system? Well, you have, for a decentralized exchange, you have basically 2 parties. That's all it takes. It takes first the so-called people that provide liquidity, and we call them liquidity miners. That's why liquidity mining. And you have the person who actually uses the exchange. We call that person the swapper, or the person using the exchange, whatever you want to use it. So obviously both of them do something, and they want to have an incentive, right? So let's first start with the swapper. Well, the swapper has 2 interests, and they can be at the same time, or they can be either or. The first one, the swapper wants the other coin, right? So the person has Bitcoin and wants DFI. The person has Bitcoin, wants Ethereum. The person has dollars and wants Bitcoin, whatever, right? So it wants the other coin. Or that person just wants to do arbitrage. So yes, he or she also wants a little bit the other coin, but at the end, he just wants to arbitrage. Now, that person has a benefit because obviously he or she is getting this out of the pool. So there needs to be a cost to that. And what is the cost? Well, the cost is very simple. There is a exchange cost. I can't remember, u-zyn corrected me last time when I explained this to the auditor. What do we call this? I call this a transaction cost, but it's not.
Commission.
What do we call this?
Commission. 0.2% commission.
I can't hear you. Maybe I can't hear you, but I cannot hear you. Maybe it's just
commission.
Me. Can you write it in there, or can anyone else hear you and I can't?
Is it my mic?
Okay, we can hear him. Sorry, then I'm the something on my audio is not good. Commission. Okay, so this person pays a 0.2% commission. And so obviously the question is, where does this commission go? Well, obviously there is a second party, and that second party, just like before stakers and miners, they get two things. They get the commission. The commission can come in either pair, right? So they can come in either, in this case, Bitcoin or DFI. They can come in either pair. And the liquidity miner can also get a block reward. Now, obviously, that block reward always comes only in one coin. So generally speaking, liquidity miners cannot compound automatically like stakers, because generally there's always one coin that dramatically this liquidity miner gets more than the other coin. So they cannot automatically like compound. That's why in liquidity mining, there is an APR and not an APY. What we offer, for example, on Cake, though, is that people can stake DFI automatically that they get from liquidity mining. They also get always a little bit Bitcoin and or DFI or ETH and DFI or Tether or USDC and so on, for the very simple reason because there's also this commission. Now, again, question for everyone, where does the return come from? Well, it's the blockchain that creates an incentive for people to provide liquidity. So it's actually a fee that everyone in the blockchain actually bears. It's a cost, again, that everyone bears in order to run that DEX. And so people need to kind of counterbalance and say, yeah, it's worth it for me or it's not worth it for me. And so at the end, that's where the reward is coming from. And yeah, so that is, yeah, I think a very elegant solution how DEXs work. And that is exactly what you can see here on our website. So you can see here, this is the Bitcoin DFI pool. It pays 65% per year. And you can see both pools. And one thing that you can actually see is, and that's what Cake does, it automatically checks how well is the DEX balanced versus other centralized exchanges. And so you can see this here, right? And so that is a really, really nice comparison with the ETH DFI and the USDT DFI and the Litecoin DFI and so on, right? So it's a really, really nice kind of balance here and comparison. And you can always see the pool that's in there. Now, obviously, there's now one thing that is important, and that's, let me just open the chat in case I forgot something here. Let me go into the tablet again. There's one thing that is important here, and that is why we call this a high volatility product. We talk about a pair, right? We talked about the BTC DFI pair. And let's say this pair starts out with 1 and 10,000. Now, just imagine you're the person and you say, you know what? This pair pays 65% APR. Great, I'm getting 65% on my Bitcoin. I'm getting 65% on my DFI. Obviously, this is being paid out mainly in DFI. You can then swap those DFI back to Bitcoin. And there's always a little bit of BTC paid out as the commission. That's not the volatility. The volatility comes now from this. Imagine you want to add liquidity and get your returns on there. The key concept in all of the liquidity mining, and that's how everything is being kept track of, is what is your percentage of the entire pool. So it's about pool percentage. You don't actually own coins, you own pool percentages. So in this case, now there's 2 BTC and 20,000 DFI, you own 50% of the pool. In this case, also 50% of the rewards. Now, very unlikely that you would ever have this, but just for the ease of explaining this here. Now, let's just say there is a swapper now, right? That swaps like crazy. And what that person basically does is, that person puts in a lot of DFI. For example, that person puts in 20,000 DFI. Now, the way the function works is putting in 20,000 DFI doesn't give you all the Bitcoin on the left because you're basically adding 100% of the coins on the right. You would actually be getting 50% of the left side. So the person would be getting 1 BTC. So that person is actually not having a very good exchange ratio, but let's just say that person wants that. Now, what happens after that swap? Well, very simple. Now there's only 1 BTC in there, but 40,000 DFI. So that's BTC DFI. And now say you want to exit the pool right now. Why? Because you need money. Okay. When you exit the pool right now, you're having 50% of the pool. You don't have actual physical coins. You always talk about pool. In this case now, you would be getting 0.5 BTC and 20,000 DFI. And so now here comes where the so-called, and this is now a term called IL or impermanent loss, and that's where the volatility comes from. This bucket here that you're getting out, plus the rewards you are getting, right? You always get rewards, don't forget that, that's why you're doing this, has a dollar value. And that dollar value needs to be compared to what you actually put in. And again, it should have, and in most of the times, this dollar value here is higher than the one that you put in. But again, there's no guarantee on that. And so even though everything is working fine, right? So if staking works fine, if lending works fine, I can assure you, you get more coins out that you put in. I don't know if the dollar went up or down, but I can tell you for sure that you get more coins out. In liquidity mining, even if everything works fine, everything works completely correct, I cannot assure which of those decisions made more sense. Did it make more sense not to join liquidity mining and the 1 BTC and 10,000 DFI, even though the price might have dropped, right? Again, the price might drop. I cannot promise you that this number here is higher or lower or the same than the number that you're getting out. Most of the time it does, and that is why people do actually liquidity mining, and with most of the time I'm talking about 99%, but there's always this small chance that what you're getting out is actually a lower part, and that's what's called an impermanent loss. It's very, very, very difficult to predict if you have an impermanent loss. In general, you can say if the price of coins moves apart significantly, there's a higher impermanent loss than coins that move together. Because when coins move together, then it's just not possible to have such a dramatic loss, because then it's very unlikely that dramatic exchanges happen. And that also causes that large pools of coins synchronize, because there's such a high interest for people of those coins to keep the pair stable. And that is actually a reason why the pool of DFI and Bitcoin is actually so synchronized. And that is a reason why BTC and DFI actually trade so well together, because there is such a large pool that actually provides people with a penalty for these coins to move apart. And so, that's just the explaining here. And so, when people provide this liquidity, they get their return. Hopefully, their return plus what they put in outperforms what if they had stayed with the original. In 99.9% of the time, it does, but we can't guarantee that. And so that's why we call this a high volatility product. And that's also why you get really high returns here, because here you're getting 65% on your Bitcoin and you're getting 65% on your DFI. And so, I mean, that's insane. That's like 10 times more than you're getting normally in your Bitcoin. So for example, when people come to me and I get asked this literally on a daily basis on Twitter, on Instagram, I have BTC and DFI. Should I lend BTC and stake DFI, or should I put my BTC and my DFI into liquidity mining? And the only answer to give here is it really depends on your volatility tolerance. That's what it comes down to. Because in lending and in staking, if everything works fine, which I expect, you're going to have more BTC and you're going to have more DFI afterwards. If liquidity mining works as intended, I cannot promise you if you have more BTC and or more DFI afterwards, even though everything went fine. And the reason is very simple, because of that impermanent loss. And that is just important to understand. But in return, right, there's a flip side to that. In return, you have way more return on your BTC. So maybe the best solution is to do both, right? To have a bit of a mix. And so that is, I think, important or relevant to understanding all that. Any questions? Anything I left out? Because then let's do a very quick preview. And that's what we're going to finish with. So let's talk about, when we scroll up here. So let's talk about, so basically the DEX here, exchanging value, that's live. So let's talk about that tokenizing value and predicting value. So let's talk about that next function that's coming out. So that's product number 4, and that's tokenization. Tokenization in its purest form means that you have a token, and generally that represents something, mostly in the physical world. Many people call this also stable coins. So tokenized tokens are, for many people, stable coins. Now, you can actually create stable coins on anything. You can create stable coins on the dollar. We have that. You can create stable coins for gold. We have that. But you could create stable coins for anything out there, also for stocks and so on. So now always the question is, how do you make sure that the price of the token actually represents the physical thing? How do you do that? Well, the easiest one is you do it centralized. And you do this by actually putting dollars or the stock or something, you put this into a vault, and you say, look, I prove to you that I have $1 billion, so I'm going to create 1 billion tokens, and at any point you can come to me and you can give me $1 and a token, and I'll give you $1 anytime, right? So it's very unlikely that these tokens ever fluctuate away from $1, because why would they? If the price would be too high, people would immediately sell them simply because they would make a lot of money in the dollar. If they were too low, they would immediately buy them because they know they would go back to $1. At any point, they can actually get the physical dollar for it, right? So they would actually arbitrage it. So that is the first option. Again, we have the same tools, right? It's super fast, it is efficient, and it's really cheap. And it actually is super cheap, and people, again, don't believe that. But if you look at, for example, USDT or USDC, people don't pay anything to have that, right? I mean, they're pretty much free. You can transfer this for free suddenly, right? So it's actually very, very, very powerful to see that. But again, it always comes down to one thing, and that is trust. So it's always trust. So the question is, can you do this decentralized? And again, there was, I think Maker was the first one to actually do it. They made a decentralized US dollar, which is called DAI. And one DAI should be $1 US. How do they do it? Well, instead of locking up the physical thing, like $1, you have to lock up something that is worth more, and that is on the blockchain. And what is that? Well, obviously, it's another cryptocurrency. For example, ETH. And so what Maker said, you can create a vault. You put 1 ETH in. Let's say, just for the sake of argument, ETH is $1,000. Let's just make it simple. And for that, you are allowed to create, again, let's make it simple, half of that in actual US dollars. So what happens is, since this ETH is $1,000, you can create 500 DAI. And this is how DAI is created. In order to get the ETH back, the ETH is stuck in that vault, you need to fill in the DAI again. So since these ETH are worth $1,000, there's a very high incentive to always put those 500 DAI back, because you would get actually $1,000 out. Now there's obviously a couple of questions here. So the first question is, how can you create pressure to force people to always pay it back? And that is where something called a stability fee comes in, which is actually nothing else than an interest. And so the first thing you need to introduce is an interest. And that interest depends on a lot of factors. It's about economics here. You always need this interest. So that is always pushing the at the end, it always pushes it that you want to pay back because you need to pay back more and more and more in order to get your ETH out. And the other thing is you need to have a price oracle, because the blockchain needs to know how much is that ETH worth on centralized exchanges. Well, it's worth $1,000, but the blockchain doesn't know that, right? Because as soon as this $1,000 actually drops below the level of what you're borrowing out, the vault has to dissolve. It has to take away basically 500 DAI and give an ETH back. It has to dissolve that. And that's what the price oracle is in charge of. So it needs those two things: price oracle and a stability fee. If you have that, you can actually create a decentralized token, decentralized tokenization for anything. This can be obviously for currencies, but this can also be for stocks. This can be for bonds. This can be for commodities. This can be for precious metals, so metals. And anything else that trades on public markets. Anything. The powerful thing here is it's completely backed by the blockchain. There are attack vectors, but you can kind of kick them out. For example, one attack vector would be, and there have been massive problems with that, is the price oracle. Obviously, if you manipulate the price oracle, then obviously you can completely destabilize the entire system, because if you then suddenly tell the price oracle, hey, ETH is not worth $1,000 anymore, now it's only worth $300, obviously all the vaults would start to collapse. And so what you always want to have is you want to use several oracles. And so when you hear David talking about like all these various companies that we work with, NASDAQ and so on, it is because all these companies provide price oracles in order to make sure that we're using an average for all those prices for all of that. And so now the question obviously comes, how does this work? And why would someone invest in them? Or what is the incentive in all of that? Well, so far, you have not seen that much incentive, because if you, and now comes the interesting part, if you, for example, lock up DFI and or BTC, you're going to be able to do it with both. Yeah, let's say you lock this up and you put it into a vault. And let's say there's $1,000 in there. And then let's say you create a Tesla share. At first glance, you still have your DFI and BTC. So you're long DFI BTC, obviously, right? Because you still own them. They're still in the vault. But now you have a Tesla share. Let's discuss what actually you want with the Tesla share to happen. But first, you pay an interest, right? You have to pay an interest in order, like you put a little bit of Tesla share, you take Tesla share out, but you have to pay a little bit more back. So there's always a pressure to at some point pay that back. But what you're really actually doing, you're hoping that this Tesla share is actually going down in price. Because what you definitely don't want is that the Tesla share goes up and is worth more than your vault, because then your vault basically gets dissolved. So the first thing that you're doing, if you actually create the share, is you're actually shorting whatever you're creating. So shorting means you're betting that this thing goes down. And you're long, so you're betting whatever you put into the vault, that it goes up. So now obviously the question is, why would you do this? Because maybe you don't want to be short Tesla. Maybe you're okay being short gold, but maybe you don't want that. Okay, now comes the second part. Just having a share is boring. There needs to be a platform to exchange that share. And so now we have a DEX. So on the DEX, for example, there's a USD Tesla DEX. And there is liquidity mining on there. So now suddenly the entire system that we have built and that everything comes together is suddenly coming together here. Because now suddenly, let's say the Tesla liquidity mining can be insane. It's a supply and demand. You could be making 300% APR, 300% per year for creating Tesla shares. So you put them in here. Now what happens? Well, someone can put dollars in here, right? Puts dollars in and gets a Tesla share out. So now the dynamics change a bit. Why do the dynamics change? Well, first of all, whoever holds this Tesla share here and does liquidity mining with it gets massive cash flow. So that's obviously super interesting already. Massive cash flow. Holding Tesla, 300% APR. Insane. At the same time, this person is long Tesla. Right? So Very, very interesting dynamics. Another person is short Tesla, but has also put it into the liquidity mining pool. So now you're wondering, how is this possible? There's not two people here in the liquidity mining pool. Okay, let's think this through. What would have happened if it was really only two people and no extra Tesla share? Let's make it simple. Let's say the Tesla share is worth $500, just to make this simple. Then this person would have put in $500 and one Tesla share. So let's say that person wants to buy a Tesla share. Well, he actually can't buy a single Tesla share because that's everything that's in the DEX. So you would have to actually put unlimited amount of dollars in to get one Tesla share out. So that's not possible. Let's say this person adds $500. Well, he's doubling the left side, so he's getting a half out on the right side. So now he has half a Tesla share. So let's look at the DEX, and now it starts getting its own dynamics, and now it starts getting super, super, super interesting. Suddenly here, there's $1,000 here on the left side, and a half Tesla share on the right side. Holy mucko! Someone is able to sell Tesla shares, half a Tesla share, for $1,000 here. Whoa! So is people gonna see this and they're like, holy shit, I need to create Tesla shares. Why? Because I can create one Tesla share in the vault for $500, but on the DEX, they're actually worth twice that. They're way more worth. So I can actually sell the Tesla share on the DEX and I make a net profit. And so what's gonna happen in the entire ecosystem is that the vaults and the DEXs, and basically all the price are gonna find an equilibrium, and it's gonna find a balance, and it's gonna balance it out. And so what we're gonna offer at Cake, we're gonna offer exactly that liquidity mining part. That's what we're gonna offer at Cake. We are not gonna offer that creating on Cake, and we're also not gonna allow the DEX on Cake, but we will have an easy forwarder where people on the Cake website have a forwarder, and that is why I know there's so many puzzle pieces and you're watching this and you're like, holy crap, there's like using the mastermind, signing all that. We have the Light wallet here that allows obviously the very easy access. And so Cake can stay the tech platform that is basically a custodial wallet. And now this is really important, that does not allow buying, selling, or trading, but only stores that, which from a compliance standpoint is going to be so disruptive in comparison to all these other platforms out there. And then we basically can integrate here and allow people a very easy access to a third-party tool, similar like how we use Banksa or Transact for fiat. And people on Cake can get cash flow, and they can, if they want to, create vaults via the Light wallet, via the DEX. They can do the DEX very easy, and now suddenly people can get access to stocks, precious metals. They can get insane returns on that. And for those that are the experts, they can actually start playing around with the vaults and on the DEXs. And so that's what we hopefully have on the platform end of Q3, beginning of Q4. And just to kind of finish this, and then I'll look into the questions because I assume there are a couple of questions. You can then put another layer on top of that, right? And that's next 2022, and that's prediction markets. So now you start putting the exact same things. You start putting pools of bets on other pools, completely decentralized. And so this entire discussion that people have around Binance is not allowed to offer like futures anymore or options anymore, or the SEC is going to try to stop that. It's impossible to stop that because it's actually happening on a DeFi chain, right? It's completely independent of Cake. Cake only goes and says, hey, you know what? You have a token that is a bet on where Bitcoin is in 6 months. You cannot buy this. You cannot sell this and you cannot trade it on Cake, but we allow you to store it on Cake. And if there's any benefits attached to it, you get them. And that's now suddenly the prediction markets. And then if you kind of put this all together, it is insanely disruptive to what anyone out there is doing. It's super disruptive to any bank, to any fintech bank, to any new bank. It's disruptive to Robinhood, and so on and so on and so on. I think most people just cannot even grasp the entire understanding of that. It's going to be insanely value bringing, in my opinion, to DeFi chain. And that is why it is so important to make sure DeFi chain is 100% decentralized, right? It's not allowed to have single points of attacks. And I know there's still room for improvement there. I get it. But I think we're doing really, really well already. But it has to be 100%. And then at the same time, it's about this easy user platform on Cake. That's just going to blow everyone away. Great work on that, user. The APY, again, you will see that all these layers at the end are stacked on top of each other, right? So that's where it gets really, like, everything that we did, I mean, had a bigger mastermind picture behind it. It needed the lower level for the next one, for the next one, for the next one. And that was really important to understand in all that. So hopefully by the end of 2022, all those functions from 1 to 6 are like super smooth, are like all over and completely decentralized, and that will be really great. Will it be possible to buy stock tokens directly on Cake, or do I go through the DEX and withdraw the Cake? So you will have to go through the DEX, but it will be similar to how Banksa works. So that means in Banksa, it's actually very similar. You instruct Banksa to buy Bitcoin with your credit card and then deposit those Bitcoin onto an address. Where this address is, Banksa doesn't care. It's the same on the DEX. So you instruct the DEX to use dollars or DFI to buy a Tesla share, and then you instruct it to deposit to an address. If you remember, that's always when you go into the DEX, you actually see a deposit address. It's exactly the same thing. Just here, this deposit address is going to be populated with an address that you control on Cake. It's exactly the same thing. So you don't have to do 2 clicks. It's still 2 steps. It's still a swap and a deposit, just like on Banksa, but it basically is auto-populated. Decentralized via internet lockdown. Ooh, I think that's a really far stretch, Pinglai. I mean, u-zyn already writes, it's indistinguishable, the traffic. I mean, there's a lot of people who analyze, could you block certain ports? Could you do certain things? My answer to all of that at the end is, like, I think that's such an unlikely scenario because you're causing so much collateral damage and you would cause so much friction with people that I don't think regulators would have to go this route. I think regulators would rather go and, I don't know, pin down on exchanges. Look what's happening. There's a reason on why I always focused on not being an exchange. I saw this coming in my past company already 3 years ago. And I was always someone in my past company who said, I don't want to go this banking route. This is going to kill the company. And at the end, that's exactly what happened. I think the key thing here is not being an exchange. I know it sounds super counterintuitive, but that is what's going to make Cake win over the long run. That's what the regulators are doing. Regulators are pinning down on exchanges. It's going to go more this route. And I don't think they need to block traffic. They're going to go, and 99% of all decentralized projects actually centralized. And I think the regulator is going to pin down on them. And that's at the end what's going to make us win. Peter, the DEX on Cake is the DeFi chain DEX. In the future, and that's also something that's going to come, we're going to be integrating many DEXs, right? But no DEX is going to be built by Cake. So we're going to go and look at on Ethereum, what DEXs can we integrate? We're going to look on the Binance Smart Chain and see, hey, can we integrate DEXs there? obviously DeFi chain, DEX, and so on and so on. So the key thing is, once we have built this entire ecosystem in one flow, we're gonna add tools from other systems that really work well. At the end, my vision here for, let's say, 2025 on Cake is completely blockchain agnostic, access to any kind of DeFi tool out there on a simple to use platform. And I still believe DeFi chain is going to be the largest winner out of all of this, simply because it's so targeted towards its use case. But in 2025, DeFi chain will be just one of many, many blockchains that Cake is going to be centered around. And that's absolutely good. I mean, that's absolutely fine. That's good for DeFi chain. That's great for Cake. So that's going to be the long-term vision here. Correct. Makes absolutely no difference. In terms of rates, Cake is going to charge a small handling fee, just like it does on Banksa. I don't know, maybe 0.1, 0.2%. It's definitely not going to be like a massive amount, because it's actually a market rate, right? So the reason why we are charging 5% right now is just so people cannot arbitrage. But in that case, they cannot arbitrage anyways, because it's actually the DEX. So there's no way to arbitrage. So we're just going to charge a small handling fee, just because, I mean, we should. We are providing a service. But at the end, it doesn't matter if people want to use it themselves. Would DeFi chain network transaction fee, the absolute amount, adjust to the market price, higher market price, lower absolute amount? I'm not being like, I'm not 100% sure I follow the question. At the end, the transaction fee on any blockchain is always a bit of a supply and demand. So the more people want to get their transaction information into a block, the higher fee they're willing to pay. DeFi chain was always designed to very unlikely, let's say this way, ever have high fees, just because of the way it is designed. And again, it makes some sacrifices in return, right? And some of these sacrifices are that it definitely, like, it wants to use Bitcoin as an anchor layer, just to kind of be extra sure, and it uses proof of stake instead of proof of work, and there will always be a certain criticism to that, also a certain praise to that, because DeFi chain doesn't use as much electricity. It's always a trade-off, but yeah, that's kind of the idea here. Yeah, Cake is a bank without being a bank. I think that's really important to understand. So, I mean, I would love for, in 2025, people really say, hey, wow, I can do everything I can do on a bank on Cake, but Cake should never actually be the bank. It should always be the intermediary. And then maybe at some point, right, we can really make it even more trustless for users, that they have, I don't know, certain tools or certain access points, even with a ledger, with additional features for them, where, yeah, we always need to provide maximum transparency to our customers. Obviously, we will have always a certain amount of custodialship. It's impossible to give that away. But the more transparency, the more security, the more we can give to our customer, the better. And I hope, yeah, that is a route that we can always go. We definitely don't want to get a banking license. As soon as we do that, we go the exact wrong route, because we would actually fall exactly for that same trap that so many companies out there fall for, and then they lose. The goal is to do the exact opposite. The goal is to assure the customer that every dollar that customer deposits with you, or every Bitcoin, is there, right? And that is key. At the end, that's what you want. That's what's really relevant. On the other hand, it's important that we don't onboard any criminal customer. We don't want to onboard money launderers. We don't want people with illicit activities, and that's super important. But anything beyond that, I always believe a Bitcoin, a customer deposit, is their Bitcoin. And as long as that Bitcoin was acquired legally and is used for legally, like, sound reasons, we should not, like, actually block a person from using their money. Nothing pisses me more off when I want to transfer money in or out of a bank, and the bank asks me, what do you use this for? This makes no sense. And a blockchain actually allows that, right? Because you have blockchain analytics. And so that's the beautiful part. So to me, Cake could disrupt banking in a way how banking should have always been designed. And I think that's the beautiful part where I would love to see our company go. Yeah. Cool. But I hope that explains to you the products we have. It explains to you a bit of the, let's say, the next 12 months. And I hope it explains to you a bit of the next 5 years. the vision on where this should go, right? And that's what this video is about. And I mean, hopefully, when you watch this video in 3 months, we are a bit further, and hopefully, when you watch this video in 6 months, we're already way further. And hopefully, when we ever watch this video again in 2025, we're like, man, we outperformed this vision by so much. What small thinkers were we? I think that would be so beautiful if we could ever do that. Yeah, and I'm really, really confident that that actually we can go that route and we can do that. We have been talking to lawyers in Singapore and in the US about the legal feasibility of all that. And so far, all our lawyers have signaled that this looks really good. They want to see always wireframes. They want to see designs on what the product actually look like. Can everyone become a lord? Everyone except for you, Kavi, because you are what? You are what are you? This lower tier, an earl. Ah, yeah, right. So you're stuck there. Everyone else can. Oh, a dude, right? A dude. Yeah, sorry, no lord for you. You'll stay an earl. But yeah, that is and that is a really key thing. I think from a legal and compliance standpoint, from today's perspective, we're doing well. I think everything is straight. I think from a product standpoint, I'm confident in delivering. I think we have a way in acquiring customers. Do we know every step along the way over the next 5 years? No, we don't need that. But I'm very confident that our team is so strong that whatever crossroad we get to, we're going to figure out what decision to make to not screw this up, but to actually get further ahead. Definitely very cool. Yeah, very much looking forward. I hope that explains it a bit of the vision, a bit of how all this started.